Welcome to the Become Sensible podcast, where we discuss practical accounting, finance, and tax for everyday business. I'm your host, Fiona, and I'm here to show you that no matter what your business financial situation is, you can change it. Good morning. Welcome to the podcast Become Sensible. I'm your host, Fiona. Today, we discuss about something that probably on the top of many business owners right now. That's tax planning. If you look into your business financial number and you see that you have a profitable years, it's very important to understand your tax position and tax strategy that will help you in terms of save, in terms of tax liability, but it also help your business income, business financial growth and decision. So that is what we will discuss. What is the practical tip and strategy you can use and help you to make better decision in terms of tax planning? But I also know this episode will be aired on Thanksgiving Day because we always publish the podcast is on Thursday. So you probably listen to it while you have Thanksgiving with your in the afternoon of Thanksgiving. So I would like to take this moment for me and my team to appreciate you and grateful for all of your support, sharing your tip and feedback over the last couple months, and we really appreciate it. Thanksgiving is one of the most favorite holidays here in the US for me. And one of the things is my mantra in life and in business is that regardless what all the things happen or what was happening, I always appreciate the opportunity and the time that people give me and support me throughout the years. And I wish you and your family a happy, very happy Thanksgiving. So now let's diving into the podcast today. So number one, let's discuss about understanding the basic of why tax planning is very important. So there's two things. Tax planning is not about avoiding paying tax, but it's about being strategic with your money. Instead of use that money to pay tax, you move that money into strategic investment by using the various tax code provision to build your wealth in long term. And this is about make your money work harder for you. Number two, smart tax planning is not just about spend the money to take the deduction, but this is in strategic, in spend the money that help you to grow your business or give you the return on investment in the next couple years. So that is the basic fundamental of the reason why tax planning is very important. Now let's talk about some basic technical consideration. Number one is about cash basic. So if you are on cash basis taxpayers, which is more of business owners and is on that is mean all your expense or your actions should be by the December 31st to take into consider for this tax year. Some of them some of them have a special regulation, for example, solo 401k. The employee deferred earning also need to be happen by December 31st. But if you have SEP IRA or the employer side of solo 401k, the deadline will be the day that you file the tax return of your business. But that is the basic of it is cash basic need to be considered by December 31st of this year. If you're on accrual basic, timing may be different, but you need to look into your tax return to see whether you're on accrual basic of tax filing. And cash and accrual is basically if cash pay, the money coming in, you record as the revenue, the money coming out, you record as the expense. Accrual is not that way. Regardless when you receive the monies or you send the money out, When the works is performed and delivered to customer, that should be recognized as revenue. And when your vendors or your contractor perform the work and the works is done, that should be spent. So it's basically not when your cash receive spent. I know it's a little bit confusing, but most of the time, small business owner and business owners like under 25 millions on cash basic, but you need to double check on your tax return. Number two, you need to understand the effective tax rate. Because why? Because that's help you, okay, to see like, okay, if you divide this, your tax payment, tax liability over your total income, you will know, okay, what is your effective tax rate? Is it 20%, 25%, and 30%? Tax brackets is different. Tax brackets is because it's like it changes by when you jump into the next tax bracket. But effective tax rate is basically an average of total tax amount that you pay divided by total income. And why this is important in the tax planning? Because you will know that, okay, average, if your tax rate is 20%, if you make this decision to do something for your tax planning or strategy for tax planning, you will see, okay, will your return on investment, your saving on investment is like effect with your tax rate, or is it lower, is it higher? That's help you to make better decision in terms of tax planning. And finally, you need to know how much year-to-date tax payment that you already paid, that is estimated tax withholding on your salary, your W-2, to avoid the surprise and penalty. Ideally, like tax planning need to be like happen throughout the year. But this quarter is like the last 2 months of the year will be very important and crucial for you. But if you haven't done it yet during the year, this is the time that you need to make sure that you taking care of your tax planning very well. Especially you make profit in this year, especially if your business grow and the profit is sizable. Make sure that you consider is very well. So now talk about cash flow. Why cash flow is coming into the tax planning conversation? Because end of the day, you move the money that you need to pay for tax to do something else. And sometimes it also requires a larger amount of investment compared to the tax amounts that you will pay in terms of tax liability. It depends on your situation and the strategy that you choose to do. And that is why it's very important to check your cash position. Without cash, so many things that in terms of tax planning is not going to be work. The reason why is most of the time, if you use leverage or borrow the money from someone to do it not gonna be like enough. I think like if you buy a building or office or a house or a car, you need to have a down payment in it. And that's like a big tax move. You still need to have a down payment in top of it. So make sure that you check your your cash flow position. So in cash flow management, you need to have number one, knows your break-even point. What is the break-even point? That is a very important concept that I think many business owners never pay attention in. That is how much it costs you to maintain your operating. If like all things fail, how much is the minimum that you will need to get your business running in the next couple months? Every single month, you need to know that that's maybe like $50,000 per month, maybe 30,000, maybe $100,000 per month. Whatever that number, you need to have it in the top of your mind. So this helpful in terms of cash flow management for tax planning because you need to save at least 3 months of your business cash flows requirement, like the break-even point. Like for example, if your business needs like $50,000 every single month to maintain the business floating, then make sure that you have around 120 to $150,000 cash in the bank, so that if whatever happened on the markets, on the economy, on unlucky situation, you have the foundation to survive the situation. So that is break-even point. Number two is You need to consider about like seasonality in your business. Will in the next couple months, your business will have a drought in terms of cash flow because it's off season for your business. You also need to like factor it into upcoming like large expense, maybe like increase the salary for your staff. Maybe that's equipment purchase. This cash flow projection for the next 3 months at this period is very important because otherwise, if you use the money and you move into like other tax strategy, you run out the money in terms of operation. You need to balance this cash reserve for operation, tax obligation, tax liability, obligation, grow investment, and like debt management. If you listen to the cash flows episode, I tell a little bit like more detail in terms of how to do cash flow projection and how to help you like address all of these things. But if you can't do yourself this situation, have a CPA to help you to take a look in all what the thing is going on in your business and the key priority that you need to take care. That help you to plan the money for tax strategy so much better. Okay, so now we talk about smart year-end spending strategy. So there's couple and all of this is legal strategies. So there's nothing that like saying that we are doing right right now. Is it's just tech code that you actually can do. And couple of the strategy I can list out over here. Number one is prepay spend. If anything that you know that you will like use this like for example subscription based software, you need to know to pay the the next year, you can pay for the whole year subscription. You can pay for insurance. That's normally like financing is charged you the fee. And now you have the cash. You also can cover that insurance. Like my office, we always like pay for the whole year insurance. Never pay. It's like over 12 months. It's safe. It doesn't need to be financing it. And I also can take the deduction right away. So timing your strategy is very important. Or like you need to be like upgrade your office, whatever it is you plan. Instead of doing it in January, you can do it upfront like December so that you can take that deduction. It's just the matter of the timing. When you do it, you already make the decision to do it. And if you have a cash, do it now so you can take that deduction. And as always, expand in the business needs to help you grow the business, give you more opportunity and support the operation. So that's always the investment the spending has, the return on your spending and return on your investment. Number two is you can buy equipment. Under Section 117 and 179 allows you to deduct a full purchase of qualified equipment. And also, you can take the bonus depreciation available for both new and used equipment. Like and small equipment under $2,500, you can take the expense right away. But again, only buy the equipment are the thing that actually have for your business and use for your business purpose and have you to like create opportunity and grow for your business. Number three, you also can spend on anything in terms of benefits for your employee and for yourself. So that would definitely include the retirement contribution. And that can be like solo 401k or is this a SEP IIA? Make sure to take that consider because the money that today you invest in this retirement, $10,000. If every single year you put $10,000 and return on the market is 10%, for example, average 10%, in the next 30 year, 20 years, the retirement account, the return on that money that you invest is tremendous. This is tremendous. And today, if you do that, it saves you around 20 to 25% on your tax bill. So people always think about in short term, but if you use that money, you save 20 to 25% on your tax bill today. But then that money actually compounds into the future. So the return on investment for you is actually not 20 or 25% tax bill that you have today. Is 100%. that in the long term. So that is one of the things that should be like very carefully considered and don't skip that part. The other thing is you also can do like SSA saving, like healthcare benefits SSA saving. SSA has the benefits is that you always can roll over to the next year if you don't use it. And you also can reinvest that money. You invest it. There's some SSA account that actually have a investment vehicle with it. So for example, if you contribute into it like $4,000 per year, but when you're young, you don't have a lot of medical expense, you can use that $4,000 per year, invest it. It will grow tax-free for you within the SSA. Anytime that you withdraw it to use for your medical expense, it's not could be any tax problem. And then in the long term, when we all eventually getting older, when we retire, any of this distribution to us for medical expense is not going to be cost us any like tax at all. So it's just like very like triple benefits in terms of tax planning. So should be considered an investment into the employee benefits. Also, it not only like return on your investment, but it also improve your employee retention. Now, like all of this is theory, and there's a lot more in terms of strategy. That is depreciation is within section 179, but there's also other people can use depreciation techniques like owning the property, buy commercial property, buy a residential property to for rental. Basically, a ton of many different things in terms of depreciation, and depreciation is one of very powerful tool for tax planning. There's a ton of other like tax code that you actually can use it more. But within this episode, I want to give you some basic and fundamental that you can apply. But of course, like tax planning is very tailored to your situation. If you need is in your situation to talk to a professional CPA or like contact us, we're happy to help you to navigate in terms of tax planning. So now we talk about like practical scenario. We can look at the two scenario. Number one is your business make a lot of profits and you also have a lot of cash in the bank. This is ideal situation. So consider strategic investment in the business growth. That is the thing that you want to do. You were thinking to like, or you plan to do for your business, like open another stores or buy the equipment for your business. This is the time that you can use it because you have a cash and expansion or grow or scale the business needs some investment. But if you have a strategist in investment, it also like perfect time to do it. But again, there's nothing like to be like pressure to spend all of the money. Anything that you buy and purchase for your business, it needs to help you in either ways that save your time, give you the return, or like leverage for you in terms of resource and scale and grow your business. That should be the move that you consider. So it's just like people on the internet, people always say buy any item that is just for the purpose that you can write up it of it. It's not gonna be like any beneficial. And I mean like there's a ton of things that we want to buy, but whether it's just like map into a business strategy and the plan that we want to grow the business, that need to be considered in this situation, not just like random item or thing that you want to buy and is definitely not like high return on your investment at all. So that is the first scenario. The second scenario is you have a high profitable year, but you have a very low cash flow. Basically, in terms of cash flow, I always say you need to know which cycle that you are in. Sometimes you think that you have a cash flow problem, but this is not because of cash flow problem. It's maybe you didn't collect all of the money for the work that you perform, or like you need to write up a lot of them. That doesn't mean like it's even you have a very high revenue and high profit, but then you can't collect it. It's everything sitting in account receivable or in inventory. If it's in account receivable or inventory, it will not converts into the cash, yes, and that's make your situation is very low cash flow position. So you need to know, okay, which cycle that you are in terms of cash flow and why you in that situation to solve the cash flow problem. But then now because you have a high profit, so you face the situation that your tax bill may be high. So then number one, find the reason that you not good in cash flow and find a solution to fix it. But then understand like what is the thing that you can do in this cash flow situation in like 1 or 2, 3 months. What is the thing that you can do in terms of tax? If you can convert all of these in terms of account receivable or inventory into cash position, then you have a cash to move thing. But if this is not enough time, what is the first priority that you can do to help you to solve both problems in terms of cash flow and tax planning? Because otherwise you will have a high tax rate. So I think this situation, especially in this second scenario, need someone in terms of like professional to like sit down with you, map out the plan, and understand the reason why you are in that position and find a solution to help you with. If you cannot navigate this alone, and which is I think like so many complicated situations, it's just very hard for you to actually prioritize this. So make sure that you have someone to actually discuss and support you in terms of what is the next step that you can do, like in terms of like whether it's financings, whether it's fundraising, whether what is the next step. So that should be a very strategic discussion and it tailored into your situation. So that is why tax planning is very important. What is the steps that you need to consider? Of course, there's a lot of tech code that can help you to move other things around, but this is so much more sophisticated. So it should be like handled by professional tailored to case by case. And in general, we give you information and educational content so that help you to understand. So then you can talk to the professional that can tailor it to your situation. So the key action for you, schedule a meeting with a CPA or professional, review your current cash flow position, your cash reserve, and list the potential of investment that you can do. And one of the things is in our practice, we do a lot of tax assessment and tax planning. That is, we play the scenario analysis for you. So if you do the scenario one, what is the strategy? How much cash is cost? How much is tax saving? And how much is return on investment? So this thing is very important. Those scenario analysis help you to see what kind of option that you have and what is the thing that you can do instead of like everything list out a ton of different things and you feel like overwhelming and the requirement of the cash also like may make many people like overwhelmed with it. So build a strategy that align with your business growth, with your cash flow situation. And remember, good tax planning isn't about last minute decision. In many ways, and I always want to remind business owners, personal tax return maybe that's not that much of complicated. But in terms of business, remember, give time because if you don't have really enough time and you make the decision in terms of tax last minute, this is no way your tax situation will be in the bad position at all because anything in the last minute is always occur to make an errors. And so give time, think ahead of the game, and remember, like the people that who building well and use the tech code to like actually help them to reduce their tax liability and use it for investment and build generational wealth. Those people they don't do the last minutes and they also have an expert on their side to help it. So I think this is it. And I hope this episode is super helpful for you. Let me know if you have any question, and please subscribe, rating us, or like give us feedback. We thank you for your time, and I'm looking forward to the next episode.